morning, everyone. Welcome back to Financial Markets, International Macro. The weather is a bit better than over the weekend, and we should continue because we have quite some program left in the remaining 3 weeks, including this one. Let's see how far we come. We don't want to be too ambitious, but we should at least learn something about exchange rate models. Now, I have received almost no questions so far by email. Did we clarify your question? Well, good. I have received essentially 1 or 2 questions in this, I think 2 in this entire term, or maybe 3. I remember 3, but not more than that. I take it as a good sign that everything is crystal clear. If not, then now is probably the time to ask questions. Don't wait another 3 weeks, because then the exam is definitely coming. And of course, the best place to ask questions is here, because then anyone else can benefit from the question and the answer and can learn something. Feel free to ask whatever you want in the remaining weeks. Now, what we did on Tuesday, despite the heat on Tuesday already, was to think about uncovered interest rate parity. Which is, if you write it down, you take logs, it's just this simple thing here. 4 variables and just a plus and a minus, nothing else. It says that the home interest rate is the foreign interest rate plus the expected depreciation of the home currency. The expected depreciation of the home currency. Right? This is in logs, so because it's in logs, it's a difference of logs, that's a percentage number. So this is the expected spot rate tomorrow, this is the actual spot rate today. So this is the expected percentage rate of depreciation of the home currency. The reason is there should be no safe profits possible. If there are profits, speculators and traders will immediately jump in and exploit these profits, such that in the end all of these profits are gone, and whether you invest at home or abroad, it gives you the same return in expectations. If you earn more in one country than in the other, that has to be neutralized by expected exchange rate changes. Well, then, at the very end of Tuesday's session, we played around with that, and we noticed there are 2 ways to look on that. And it's the same expression. It's not a different concept or a different definition or anything. It's the same concept, but written in a slightly different way. Here is again the way I just described. Interest rate advantage of the home country has to be neutralized by an expected depreciation of the home country. That's all. Right? Again, if this is positive, the home interest rate is higher than the foreign interest rate, then this needs to be positive. It's an expected depreciation of the home currency. That needs to go hand in hand, otherwise investors at home would make safe profits relative to investors abroad. Okay. But then we realize this is a difference equation. There is an ET here and there is an ET there, an ET plus 1 there. And you could do this type of repeated substitution that we have already done so often with the budget constraint a few weeks ago. And that brings us, or that brought us, to this value, to this present value expression, according to which the exchange rate today, the spot rate today, is the present value of all future interest rate differentials between foreign expected future interest rate differentials between foreign and home, plus the exchange rate in the very far away future in expectations. And the computer, let me point you to where the confusion is, when we have spent some time discussing this, is because it looks as if the results are exactly the opposite, or the implications are exactly the opposite of the two concepts, or of the two ways to write it down. Here, if the home interest rate is above the foreign interest rate, you expect a depreciation of the domestic currency. But here, if the home interest rate in the future is above the foreign interest rate, this is negative, so this should fall. There is an appreciation, not a depreciation. That's totally consistent because you need to be careful, more careful than I just was, when characterizing where the expectations are. So this is interest rate differentials today need to be consistent with an expected exchange rate, expected depreciation of the home currency. But here the expectations are here about the future interest rates. So if you expect in the future foreign interest rates to be above the home interest rate, somewhere in the future, there's no discounting here. So every future period is equally important for today's exchange rate. And tomorrow's interest rate differential is exactly as important as the interest rate differential in 100 years. But if in the future you expect the foreign interest rate to be above the home interest rate, there is a depreciation happening today, which is exactly the opposite, right? Because here we talked about a depreciation. If the home interest rate is above the foreign interest rate, here we talk about a depreciation if the foreign interest rate is above the home interest rate. But again, it's about different expectations. It's about expectations of exchange rates, expectations of interest rates. So, this is essentially where we stand. But I'm sure you have over the weekend, I don't know whether you had the time or I don't know whether the heat gave you any capacity to think about these things. Do you have questions on this? I'm sure you have. Well, then I have just 2 pages left, as you can, we have already seen this, 2 pages left, which are about, well, the big question, something we haven't really talked about, is that actually supported by the data or not? This idea of interest rate parity conditions. I mean, so far, it looks nice and it looks simple and intuitive, and we make a few assumptions, I agree. Which were these assumptions? Where we assumed a completely frictionless financial system, so there were no capital controls or so, such that you can easily compare returns at home and abroad. There are no transaction costs or so when doing these transactions. There are no taxes that distort this transaction. These were the assumptions we made, right? But given these assumptions, it's a relatively straightforward thing to do. Well, but let's look whether this is actually supported by the data. So, if you remember here. So we have uncovered. Uncovered interest rate parity, which says that the home interest rate minus the foreign interest rate is the expected rate of depreciation. Right. But we also have seen covered interest rate parity. according to which the home interest rate minus the foreign interest rate is the forward rate minus the spot rate. Okay? So these are the two parity conditions we have spent time with on Monday and Tuesday. Now let's look at the two of them. Well, obviously the left-hand side is the same. So the right-hand side needs to be the same as well. And the right-hand side is the same if the forward rate today equals exactly the expected spot rate tomorrow. Right? So we should see in the data, and that's a very nice way to test this, we should see in the data that the forward rate is a good predictor of tomorrow's spot rates up to an expectations error. Right? So the forward, this is something you observe today. This is T, right? This is what you observe today. This is what you don't observe today. Because this is what markets believe the exchange rate will be tomorrow. But you are exposed, of course, you observe the realized exchange rate tomorrow. And we ask, well, is the spot rate, is the forward rate today a good predictor of the realized spot rate tomorrow? So, this is just a footnote on what is written here. If we combine UIP and CIP, this is what we get. This is the two right-hand sides. Right? The two right-hand sides combined. That's why I wrote it down here again. So what we actually test is whether the forward premium equals the expected change or the expected rate of depreciation. Now this is difficult to test. Why? Because, we observe F, but we don't observe the expectations of tomorrow's E. That is what traders have in their mind, maybe, what they think, what they believe about the spot rate tomorrow, but it's not observable. What is observable is the actual spot rate tomorrow. Right? So exposed, we know what ET plus 1 is. And here's the trick, and this is the trick that we do all the time when we estimate these parity conditions, whether it's the Fisher parity between real and nominal interest rates and expected inflation, whether it's this, whether it's other parity conditions. Okay? So we simply say the forward rate, so this is the swap rate, right? The forward premium, FT minus ET, the difference between the forward rate and the spot rate, equals the actual exchange rate change. There's no E anymore here. It's the actual exchange rate change. It's no longer the expected. That's important, right? It's no longer the expected exchange rate change. It's the actual percentage exchange rate change. How can we do that? Why can we just drop the expectations? Well, because we have added an expectations error here. This epsilon. This is our expectations error or forecast error. Right, so essentially we said, well, ET plus 1, the expected spot rate tomorrow is the true spot rate, right, plus an error we make, plus an error term we make, or minus, right, doesn't matter. And then you bring the error on the other side and then here it is. But the beauty of this is we now have realized variables here, observable variables, and observable variables here. Okay? Now you might say, well, can we just do it? Can we just write it this way? Well, we can if we make one big assumption, and I haven't mentioned it. Let's assume rational expectations. Because under rational expectations, I come to that in a second, what that actually is. Under rational expectations, we can say that this error term has to be a variable with a mean of 0. And then we can interpret this as a regression equation. So, let's take a step back. This is a very beautiful approach. Let's take a step back. What is rational expectations?
Your consumers are rational.
What does that mean?
They don't showcase rational behavior, so you're able to model their behavior.
Well, we don't maybe, I'm not sure, but what does that mean in terms of forecasting? I mean, because here we talk about expectations. So expectations are formed rationally. What does that mean?
It's not nominal expectation. Is it real with the inflations? Maybe.
Well, it has nothing to do with real and nominal. I mean, here we do form expectations about a nominal thing, but rational does not mean real, right? So this is completely unrelated to the real nominal distinction. But what is rational, the concept of rational expectations?
Maybe excluding uncertainty?
No, actually, because there is, I mean, we acknowledge that households are uncertain about tomorrow's exchange rate. They don't know tomorrow's exchange rate. But how do they deal with that?
It's like they will try to keep their predicts like as precise as possible and like it's very quickly and to keep the uncertainty level at the lowest level.
Yeah, that goes in the right direction.
Isn't rational expectations just that their forecast is right on average?
Absolutely, that's what it is. So, we are not saying they make precise forecasts each and every period. Right? We totally acknowledge they make forecast errors every period. So they are wrong every period. Okay? But the point is, they are not systematically wrong. That is a huge difference. So you always, in every period, either overestimate or underestimate tomorrow's variable, but you never systematically overestimate or underestimate the variable. Why? Well, because rational expectations means, oh, people play ping pong. That's nice. So what that means is that you use all available information efficiently. Households use every piece, that's probably what you meant by, like, they model the economy or so, but they take every piece of information into account and use it efficiently. And incorporate all of that information into their forecasts. Which means there should be no systematic information left in the forecast element. So here's the example I always give you. Suppose you estimate, you make a forecast for tomorrow's spot rate. And you realize, oh, I'm always 1% above the true. I'm always 1% above the spot rate that is eventually realized. I'm always over-predicting by 1%. Can that be a rational expectation? Or not? And why not? Well, the answer is, this cannot be a rational expectation. It's inconsistent with rational expectations, but why? So you realize every period I was 1 period too high with my forecast, 1% too high. I was always over predicting the exchange rate. This cannot be rational expectations, but why not?
Because the mean of my error term will be 0.
Yeah, but what did you not do? So in this case, there is obvious information which you have not yet used for your forecast. You know I'm always 1% about the realization. So this is a piece of information that you could use to make your initial forecast better. So apparently you have not yet used this information, right? Just make your forecast work 1% lower and you have a better forecast. But you haven't used it because you realize I'm always over-predicting. So that cannot be rational expectations because apparently you have not used every piece of information that you can have and incorporate that in your forecast. So in other words, you use all the information that you have in the most effective and most efficient way, and as a result, all the forecast errors that you make, and you make them every day, should, as you have said, should have a mean of 0. That's what we mean by they do not make systematic forecast errors. So they make forecast errors. So this is the error they make. Right? So every period, they either over-predict or under-predict the exchange rate. But on average, this is the error. This is the forecast error. But on average, they are correct. But this is not a forecast error under rational expectations. Right? Because you see, oh, my forecast error is always positive. I'm always like over-predicting something here. You need to use that information to make a better forecast, such that your forecast error is just pure random in the end, and pure noise, and fluctuates around 0. So this is, and then we will in the next chapter we come back to that. This is something we can use here, because if we believe there are rational expectations, then this forecast error has a mean of 0. Is on average 0. And then we can interpret this as a residual of a regression. We can run a regression here. We can run a regression where we just, the E cancels out anyway, but we regress the actual spot rate, tomorrow's actual spot rate, on a constant A, on today's forward rate F, with a coefficient B, and there is an error term, a residual, which is all the rest, right? Which summarizes everything in ET plus 1 that's not explained by F. All the rest. And rational expectations is an assumption that says this thing should have a mean of 0. And then we can test it. Only when we make this assumption, we can test it like this. We can put numbers, we observe this, so it's just 2 columns in your Excel sheet essentially, and you regress 1 column on the other column, and you hope that the coefficient estimate for A is 0, and that the coefficient estimate for B is 1. Because then you realize, oh, the forward rate is indeed equal to tomorrow's spot rate. Okay, it's just a super straightforward regression. You have 1 long column in your Excel sheet. This is all the forward rates of the past 50 years or so. You have another column in your Excel sheet, which is all, for every period, is always tomorrow's spot rate. And then you regress the tomorrow's spot rate on today's forward rate. And you find 2 coefficients, the constant and this slope coefficient. And you cannot reject covered or interest rate parity if the estimated constant is 0 indeed, and the slope coefficient is equal to 1. Because then, indeed, F is equal to ET plus 1, which plus a forecast error, which is exactly what it should be. So in the end, and these are the most beautiful empirical tests, I would say. You have a theory, a concept that you want to test, which is not easy to test. But in the end, you transform it in a very elegant way, such that in the end, it's just a test of whether one estimated coefficient is 1 and the other estimated coefficient is 0. It's just in the end a test of one number is equal to 1 and the other number is equal to 0. So it's a very elegant thing. But what is not so elegant, unfortunately, is what comes out. Because you typically don't find that. You don't find that the constant is 0. You don't find that this b coefficient is 1. Very often you even find that this b coefficient has even the wrong sign. It is negative rather than positive. So negative means if the forward rate goes up today, tomorrow's actual spot rate goes down rather than up. That's a bit strange. So if the forward rate prices in the depreciation, what happens is an appreciation. This is exactly what you should not, or what you don't want to see. So this is probably you know that from other courses. In finance, you test it. We look at on these parity conditions in similar ways in different formats, different courses. You might have heard about this thing called the term structure of interest rates. This idea that long-term interest rates should be systematically related to the average expected short-term interest rates over the future, over the duration of the long-term interest rate. So 10-year interest rate should be equal to the expected future one-period interest rates over the next 10 years. So this is the term structure of interest rates or the yield curve. And you can test it in exactly the same way. Now, what do we do with this result? That is, as I wrote here, disappointing. Because it's so intuitive, this concept. But it seems that we miss something. And here I give you 3 potential explanations for this failure, where I think that the first one is probably the most relevant. First one, there could be a risk premium. We haven't talked about risk premium at all. I mean, in this entire course we haven't talked about risk premium. We do that in the other course. But here, there could even a risk premium be in this covered interest rate parity condition, or the uncovered interest rate parity condition. Right? You want to be compensated just because you don't know tomorrow's spot rate. Right? And this is, if you are risk averse, you don't like this type of uncertainty. You want to know what's tomorrow's spot rate. So you want to be a compensation for that. In other words, you want higher interest rates than you would otherwise do to be compensated for this type of uncertainty. And if this risk premium is constant every period, then it's not a problem. It should not distort this estimate. But if it changes over time, if it is a time-varying risk premium, well, then it's clear that this simple test cannot give you any meaningful outcomes. And that's probably what's happening. There are risk premia, and therefore, at least these very simple regressions of interest rate parity, they typically fail. There are more explanations. Something I'm not sure we come to that in the next chapter because we don't have time. There are potentially bubbles on the common exchange market. I mean, what is a bubble? You know bubbles in other asset markets. So many people believe, if you look at the stock market valuations these days, many people think AI stocks are overvalued relative to their earnings and future earnings and so on. Some people even think it is a bubble. So these stocks have increasingly deviated from their fundamental value, and at some point they will crash back to their fundamental value. Maybe. You know bubbles in the housing market. Like the 2008 financial crisis, global financial crisis, was all triggered by a bubble in the US housing market. So there can be bubbles in all sorts of asset markets. The original, do you know whether, bubbles have been there for centuries and have been well documented. Do you know the first evidence of bubbles, this famous example?
Railroad bubbles?
Railroads? No, I think it's even 100 or 200 years earlier.
This was in Netherlands with this flower. What was the name of it?
Yeah, it's tulips. So it's this bubble for Dutch tulips, right? So you know the flower, which I think I kicked out the figure from my slides, so I cannot. Is it true? I no longer have the bubble chapter here, but anyway, you can Google that afterwards, and then you see there are these famous charts where you see the price of Dutch tulips exploding by a factor 1,000 or so in a few days, right? In 16 whatever hundred, right? And then the price of Dutch tulips collapsed. So this is the first. I'm sure there have been bubbles earlier, but this is the first one that has been documented because we know the prices for Dutch tulips. And same thing on the foreign exchange market, right? There can be bubbles. A bubble is nothing else than an exchange rate that moves very, very, very far away from its fundamentally justified value. And then it's clear that these parity conditions no longer hold because the exchange rate just does strange things and has no longer any relationship with interest rate differentials. Maybe there are bubbles on the foreign exchange market. Finally, well, this is a somewhat more subtle thing. Well, maybe the interest rates are not really exogenous with respect to the foreign exchange market. Right? Maybe interest rates also systematically respond to exchange rates. In the sense that, so that here we essentially take the two interest rates as given, right? But suppose there is a central bank in one of the two countries, home and abroad, that sets the interest rate as a function of the exchange rate. Because there's a central bank that wants to promote exports and wants to push the currency to a depreciation or so, and changes the interest rates accordingly. So then, the interest rate policy of the central bank is dependent on where the exchange rate is. And then you have another feedback loop between the variables, and then this simple test cannot really accomplish that. You should then be not surprised that you don't find what you should find. And that's it. Unless you are super eager to talk more about interest rate parity conditions. Don't worry, they will come back in the next chapter. But is there anything you want to know now? I think you were first and then I come to you.
If it is because of the speculative bubble sort of bubbles,
Yes.
then shouldn't it follow the model after the bubble is burst?
That's true, but the problem is you never know when the bubble, whether you have a bubble or not. So for these types of tests, right, you need to have data, let's say, for the past 30 years. Right? You have interest rates for the past 30 years. Every day you have an interest rate. And every day you have an exchange rate and a forward rate and so on. But it could be that your exchange rate looks like this, essentially, right? Well, that looks a bit like a bubble over these 30 years, right? And then you cannot use the data to test it. The problem is also, I mean, with every bubble, you don't know in real time whether it is a bubble or not. I mean, that's why bubbles are so dangerous, right? If you have, I mean, this could be an exchange rate or a stock price or the price of apartments, of housing. At this point, you just realize, oh, these prices go up a lot. But you don't know, is it a bubble? Or is it just because the economy is so strong? I mean, that's what people in the US thought in 2004 and 2005. They realized property prices go up a lot, but they thought this is a good sign. This is a sign of the strength of the US economy. And then indeed, stock prices should increase, property prices should increase, right? That's a sign of a strong economy. So it's very difficult to judge at what point is it a bubble and until what point is it just a sign of a strong economy. In real time, it's impossible. That's why you can identify bubbles once they are burst, but not before.
So, in that case, if there was any bubble in the foreign exchange market, then we would have actually known about it after the bust, but there hasn't been any incident of bust. Like bubble, we don't know of any incident of bubble bust after in the foreign exchange market.
We don't know it in real time. We know it exposed once it's over, but we don't know it in real time. So but if you want to test these relationships, right, you need to rely on long data series. And if there is a bubble period somewhere in the data series, well, that means that the exchange rate is fundamentally deviating from where it should be over maybe 2 years or so. And then it's clear that covered interest parity has a hard time to explain that because there's a bubble which by definition is explained by other things. But you had a question as well.
Yes, I have a question from before. You said that before the price appreciates.
This thing here,
No, just after the linear regression. Yeah.
Yes.
Equation 34.
Yeah.
You said the floor price appreciates, so it's a depreciation. Spot rate.
you mean what I said? Well, look at this. Look what, I mean, we should see. Maybe I should do it more explicitly. So, essentially we are doing the following. These parity conditions tell us that the expected spot rate is the forward rate plus an error term. Okay?
And the expected.
Say that again.
So the expected.
This is the expected. So again, this is what the parity conditions tell us. I mean, this is the expected forward. Sorry, you're right. This should go. You mean this, right? So this is what the parity conditions tell us. The forward rate should always be equal to the expected future spot rate. We don't observe the expected future spot rate, but we observe the actual future spot rate. So that should be equal to Ft plus an error term. Alright? And this thing is what we test under the assumption that the error term has a mean of 0 and a constant variance. Okay? So this is the relationship we want to test. How do we do that? Well, we write ET plus 1 is A plus B FT plus ET plus 1, and this thing should be 1, and this thing should be 0. Because then this equation is exactly equal to this. Alright? If there is no constant, if the A is 0 and the B is 1, then we are here. And that's what we want to find out. We want to see that the forward rate is equal to the actual future spot rate up to a forecast error. So we want to find that the B, and I'm concentrating on the B now, that the B is 1. But apparently it's not 1, it's even negative. So 1 means, right, if today's forward rate goes up, that this is exactly the same thing as tomorrow's spot rate is going up. So you, right? But apparently if this is negative, then today's forward rate goes up, well, which is a depreciation of the domestic currency on the forward market. That goes hand in hand with an appreciation on the domestic currency on tomorrow's spot market, which is exactly what should not happen.
So if I understand correctly, what's happening in the real, the often the forward rate is higher than the expected rate, and because of this, the beta is negative. The B is negative.
No, we cannot say it. This has nothing to. So this is the level effect, but this B has nothing to do with the level. This B does not tell you whether one is higher than the other. It has something to do with the connection between the two. It's the correlation between. The B tells you if this goes up, does that go up as well? If this goes down, does that go down as well? And this should be 1. So if this is in logs. So if this goes up by 1%, this should go up by 1%. That's what the 1 tells us. If this goes down by 1%, this should go down by 1%. But this is not what we see. We see this goes up by 1%, this goes down by minus 1% or so. Right? So the B is the slope, it's not the level effect. So here, this is FT, this is ET plus 1. We should see a slope of 1 between the two, which is, right? We should see all the data that this, right, is explained by that. But apparently it looks more like this.
And why?
Well, you can pick one of these potential explanations if you want. Yeah? Or is that, do you want to, should I repeat one of these?
No, it's okay. It was just what you explained at the end, that was my concern. No,
Did you raise it? Yeah.
Yeah, I have another question. Why does this hold? Isn't this a potential for arbitrage?
What do you mean by why this should hold?
No, why what we find empirically. So that the B is negative.
Yeah, it is a violation. I mean, it's a good point. So we started from that. This parity condition means there should not be safe profits. That is the situation that these parity conditions describe. Now we see in the data these parity conditions fail to describe the reality, which, if you turn that around, means there are profit opportunities. Exactly, and that's what people exploit all the time. I mean, this is what the entire foreign exchange market does, to exploit deviations from uncovered or covered interest rate parity. Often these deviations are super tiny, like on the 3rd or 4th digit of the exchange rate. And to exploit that, you need to put huge amounts of money into this to earn something.
But if they are exploited, shouldn't they just go away?
But apparently they are not exploited enough. So either they are not exploited enough, or they are exploited, but up to the degree of the risk premium. I mean, the risk premium doesn't go away. Even by people exploit all the return advantages, but there is something left, And if that is a risk premium, then it's clear that this simple connection is not, it's not what, like then there should be another variable in the parity condition. But I mean, I think last week you mentioned carry trades. You mentioned carry trades, and I think we talked about them, if I'm not wrong, a few weeks ago. I think this idea of carry trades are essentially one gigantic business of exploiting the failure of interest rate parity. Because what carry trades do, or did, I think most of it is over, for decades, banks and financial institutions, they borrowed in Japan, they borrowed in Japanese yen. Because interest rates in Japan were so exceptionally low, almost 0% for 20 years or so. So this was the right place to borrow, essentially for free. And then you take these yen, you convert them into US dollar, and you buy US government bonds with the money. Right? And then you earn like 4% interest. Right? So you earn 4% interest on US government bonds. You pay 0 for the money, you earn 4% on the US government bond, you pay 0% on the money you borrowed. So that's a nice little range, or profit range, which should not be there, right, if the foreign exchange market neutralizes it. But apparently this never really happened for decades. And for decades it was a very profitable business. But now, I think the Japanese yen is destroying this. First of all, from two sides, right? First of all, interest rates in Japan are no longer 0. They are relatively high for Japanese standards because inflation came back. And the exchange rate also moved, the Japanese yen, and this is no longer so profitable. But over years, I think this is what thousands of people did for a living. And with huge macroeconomic consequences on the globe, is to exploit this type of failure of uncovered interest rate. Yes.
So what will happen now with all this money lent in the past with a super low interest rate, now with a high interest rate and the appreciation of the yen?
Well, I mean, people eventually have to repay that, of course, but I don't know what happens to them. But I mean, the Japanese yen is no longer a cheap funding currency, right? It's no longer the place to go to borrow cheap and then invest at higher interest rates somewhere. This is no longer the case, and so this business is essentially ending, which has consequences for us as well. Because everything else equal, this should make borrowing even for firms and households and governments in Europe more expensive. Because this source of cheap money for the rest of the world is no longer there. Anyway, shall we move to the next and final chapter? I don't want to shock you, it's 50 pages. We have 3 weeks or 2.5 weeks left. I don't want, as I said, I don't want to do all of it. I don't even want to do most of it. But a few things. All right? Now, what is this? Well, this is a chapter that builds exactly where we just ended. It builds on this idea of exchange rates. But I think it is important to stress where we stand. We have now introduced exchange rates. We have defined real and nominal exchange rates. We have seen the connection between exchange rates and interest rates. With the exception of the Balassa-Samuelson model, we haven't never actually really talked about what determines the exchange rate. We have never said, well, this is the effect of GDP on the exchange rate, or of money, or of interest rates, or anything on the exchange rate. We cannot, I mean, we always, took the exchange rate as it is and related it to a few other things, interest rates, for example. But we haven't really made an attempt to actually explain why countries have an appreciation. Again, with the exception of the Wallace-Simmons model, we haven't really explained why countries have an appreciation or a depreciation. And this chapter is all about that. It is about models that try to explain what we see on the foreign exchange rate models. You know some of them very well. So here's a little overview. So this entire chapter is essentially about 4 different approaches. And don't worry, we don't do all of them. But you know some of them. Which one do you know? I'm sure half of you should at least know one.
Mundell-Fleming model.
What is the Mundell-Fleming model?
It states that among like 3 regions, you cannot keep the same ship like 2 out of 3. Cannot ship like 3.
That's the famous trilemma.
Yeah.
Okay, this is at the very end typically of the Mundell-Fleming model. But what are the assumptions? Do you remember any assumption? Does anyone else remember Mundell-Fleming? I'm sure you have. This is normally, I would say, standard open economy undergraduate stuff.
One assumption is perfect information. One assumption is perfect information.
Maybe, but this is certainly not the most important one. There should be one assumption that is like dominating every other assumption, and then you can have it with perfect information or without, but this is not like decisive. What is the one big assumption? Well, this is a Keynesian model. What's a Keynesian model? After Keynes, the famous economist 100 years ago. So these are models with nominal variables which cannot perfectly adjust. So this is a model in which the price level is constant. Do you remember that? The price level is constant, and because prices never change, any change in a nominal variable has an effect on real variables. So there's no long-run neutrality of money. If you change the money supply, if the central bank steps in and says, let's double the money supply, it increases real GDP because prices cannot adjust. So this is essentially, you all know, I hope, ISLM. Do you? Do you know ISLM? You do. Okay. Please be honest. I mean, otherwise I think I should change the emphasis. I thought, man, that these guys know everything about Mundell-Fleming. We should talk about the other things, but maybe you don't. And then I should not let you go out of this class without any knowledge of Mundell-Fleming. So, ISLM is the typical Keynesian closed economy model that we learned here in the first Macro 1 course, first year bachelor course, which is like you remember, you have an IS curve, you have an LM curve, and then, so this is the closed economy version. This is the open economy version of ISLM. Same thing, just plus an exchange rate, essentially. But same assumption, it's a fixed price level. Well, are you honest? Do you really don't know Mundell-Fleming? Well, okay, then we should definitely talk. Okay, I should change my plans here. So we should talk about this definitely. So these are 4 generations of models. And there is a logic, and there is also an intellectual evolution behind it. because it all began with the monetary model. And as the monetary model already tells us, this is the model where money plays a large role. And money plays a role only, in a meaningful way, only, but the emphasis is on money here, I should say, because prices are completely flexible. So, this is a model where prices are completely flexible. This means prices are completely flexible. The Mundell-Fleming model is exactly the opposite. Prices are constant. And the other two things are in between. So this is more like the 1960s, 1970s, like macroeconomic discourse. This as well, like this is in the 1970s, you have these big, in the US, like economics departments fighting each other over assumptions essentially, right? And people at the coastal universities, like MIT and Harvard and Princeton, and Stanford and Berkeley, they said, well, this Keynesian world is a good idea. But then the other economics departments around the Great Lakes in the US, Chicago, Rochester, Michigan, Northwestern, and so on, they said, no, we should talk about models in which prices are flexible. There were big fights against these, among these economists, right? And people were talking about saltwater economics, right? These are the coastal economics departments, and freshwater economics, which are the economics departments around the Great Lakes. So in the end, I think both were right, in some sense. But this is essentially the outcome of the two traditions. And then there was this famous, German economist. I think if you don't know the city of Krefeld, which is in the western part of Germany, that's where he was born, Rüdiger Dornbusch. Of course, when he wrote down the model, he was at MIT. He said, well, there is an interesting way to combine the two worlds. To combine the idea that in the long run, prices are flexible. In the short run, they are not. And this interaction between the long run and the short run, that gives rise to a particularly interesting phenomenon, which is known as overshooting. So, you know exchange rates. If you just look at exchange rate data, and you compare exchange rates, just time series, right? You plot them. And you compare that with inflation rates, or unemployment rates, or GDP. You notice what all these variables are relatively smooth, but exchange rates are very volatile, almost like stock prices. And the answer is, yeah, they are very volatile because there's this overshooting. So Dornbusch essentially was the first one who just says, well, this interaction between the short run and the long run, this generates this extra volatility that we see in the data. This is the famous overshooting. And then there is this portfolio balance model. Well, this puts more emphasis on connecting essentially what we have done in the first half of this course, the current account, with what we have done so far in the second half, the exchange rate. So we talk about the interaction between exchange rates and flows on the balance of payments, but I'm sure we don't have time for that, unless you are super eager to know all of these things. So what I suggest is, in the interest of time, is that we talk a bit about the monetary model and we talk a bit about the Mundell-Fleming model. unless you want to hear other things. But I think this is probably the two extreme versions from which you can learn the most. And the Mundell-Fleming model is still, I would say, until today, the model that is used most widely in policy circles. If you go to the World Bank or the International Monetary Fund, all these people think in terms of the Mundell-Fleming model. And we should learn that. And finally, if time allows, but this is only taking us like 15 minutes, we will do a little horse race between these models. In the end, we want to know which one is performing best. I mean, they all look nice, and internally, of course, super advanced and convincing and very well done and so on. But in the end, you want to know, as a practitioner maybe, well, which one is right? I don't want to spoil that, but the results are extreme, I would tell. And the results have changed the business of exchange rate forecasting forever. Although this result is already. Okay. Any question on this? Are you ready to start to think a bit about the monetary model? In this chapter on the monetary model, there is one concept reappearing again and again, which is the geometric sum. So it's good that you have not forgotten that you still remember this. So here's the monetary model. So this is the full title, the monetary model of exchange rate determination of the monetary model. I think I can skip that page already because this introduces rational expectations, what we have just done. Same thing here, right? I can give you the highlights. People make forecast errors. I mean, we need rational expectations in this chapter. People make forecast errors. Epsilons. These are the forecast errors. Each and every time they make forecast errors. They are too high with their forecast or too low with their forecast. But rational expectations means that this E, that's a bit unfortunate in terms of notation, this E means expectations, not exchange rate. This is the expectations operator. So the expectation of tomorrow's forecast error is 0. That's what it means, what is meant by the forecast error has no systematic component. On average, the forecast error is 0. Okay, and then essentially, as we did here, we can say the realized variable x is the forecast of the variable from the previous period plus an error. So, to make a long story short, no systematic forecast errors. We know that already because we have literally like 30 minutes ago talked about that. But this is like a little like refresher because we need it in this chapter. Yes, please.
So if the model assumes that the forecast error is just white noise, how does a structural change like a sudden geopolitical shock affect this?
Good point. Structural changes. I think so the question is if their forecast error is always 0 on average, is that consistent with long-run structural change in the economy? And the answer is, I would say, yes, it is consistent. Because what that means is, as I said earlier, you use every piece of information efficiently. So if you anticipate that there is like a war coming between Russia and Ukraine, you incorporate that already today in your expectations. So if the war then actually breaks out, you have already anticipated, it's no news because you have already anticipated that. So in the end, what matters only for exchange rate and the rational expectation is the news, it's the unexpected part. So even if you think there is a long-run structural change in the way the economy evolves, a big part of that can be anticipated. So you know, well, there are more and more tensions between the US and China. Or there is, I don't know what, oil prices, or there's like, whatever, geopolitical divisions between countries. A big part of that is anticipated and is therefore incorporated into your expectations. In the end, only the news, the unexpected part, is left, and that should have an effect, but not the expected part. It's like stock prices, right? Where we typically assume the stock price is driven by the news, not by the thing that everyone has already anticipated. Right? So if Google says, well, tomorrow we will throw out our CEO, then you should react, the stock price should react today and not wait until tomorrow, right? Tomorrow is no longer news. Tomorrow everyone anticipated this. So maybe this was a confusing answer, but yeah. Okay, so this monetary model has 4 ingredients. Only 4. Here they are. UIP. Fine, we know this by now. Second, PPP. We know that as well. Third, flexible prices. Fine, which is the defining feature of this model. Prices are flexible in the short run and the long run, not just the long run. Prices are always flexible. And I mean, maybe you remember that from your previous macro courses. That has drastic consequences. If prices are always flexible, then in the end, money is neutral. What does that mean? So in this flex price model, or in any flex price model, if the central bank wakes up and says, tomorrow we double the money supply in order to increase GDP, to create jobs, what happens?
Yeah, all the prices double as well.
All the prices double as well, and GDP stays unchanged. So nominal variables are neutral with respect to real variables. If you change nominal variables, they have an effect on other nominal variables, like prices in this case, but not on real variables. For that to happen, for nominal variables to have an effect on real ones, you need to have prices which are not perfectly flexible. And again, the Mandelfieri model is the exact opposite, where if the central bank doubles the money supply, prices don't change at all because they are assumed to be constant, and you have a huge boom in the economy because GDP goes up. Prices cannot adjust, GDP can, and therefore you have this big boom in the economy. So completely opposite results. Just because you assume fixed prices in one case, flexible prices on the other. Okay, here it's flexible prices, so money is neutral. In other words, nominal variables are neutral with respect to real variables. Okay, starting point, uncovered interest rate parity. I think we can be brief here because we have done what comes next already last week. Here's uncovered interest rate parity. Home interest rate, foreign interest rate, expected home depreciation in percent. This is a difference equation. So we can do this repeated substitution. We can put this equation into Excel infinitely often. We have done it last week already. You haven't asked any question on that, I believe that everything is fine. If not, let me know. But if we do that, we get exactly what we talked about earlier today. The exchange rate is the present value of all future interest rate differentials. Same thing, literally copy and paste from the previous chapter. Plus the exchange rate, the expected exchange rate at some point t plus big T, where the big T goes to infinity. So this is the expected exchange rate in a million years, in very far away times. Okay, fine. Let's put that aside for a second. And let's introduce the other ingredients. And one is, of course, as you remember, purchasing power parity, PPP. So by the way, the monetary model, we have to do it analytically. So we do lots of present value terms. The Mundell-Fleming model, right, which we then do next week, the Mundell-Fleming model is the opposite. We just shift curves, essentially. And we do it graphically. So, PPP. I hope you remember. PPP tells us the nominal exchange rate adjusts such that the real exchange rate is 1. Or the nominal exchange rate is just equal to the ratio of the prices. Here it is. The nominal exchange rate is home prices minus foreign prices. Here's everything lost. Right? So this is PPP as we know it. Home prices, spot rate, foreign prices. Okay. So now comes the final component already, and then we are already done. The rest isn't that, just combining these things. Well, this role of flexible prices and money, because I mean this, the name monetary model comes from the fact that there has to be money somewhere. And here it is. Here is money for the first time. We actually see money. And the way we introduce money is as follows. We write down money demand. I'm sure you all have heard or seen money demand at some point. Do you? Have you heard, have you seen like things such as M over D is the function L of Y and I? Not really, right? Okay. So, what is this? So let's talk about money. Now, money is supplied by the central bank. This is MS. This is in logs, right? MS is the money supply in logs. This is the money the central bank injects into the economy. But this is not necessarily the amount of money that people actually want to hold. Look, we talk about money. We don't talk about like being rich or being or being whatever, right? Being rich or having high consumption rate. Money is just for transactions purposes. So it's not clear that households actually want to have so much money, right? So we need to look at money demand. And then money market equilibrium is where money supply equals money demand. Okay, where the supply of money equals the demand for money. So this money supply is exogenous. This is what the central bank does. The central bank is the monopoly supplier of money, and therefore she can change money as much as she wants. Right? But what about the demand side for money? The demand side for money is you and me. And the argument here is as follows. First of all, we say, well, we look at the real amount of money. So this is in the home economy. So, again, this is in logs, this is in logs. So in levels, this would be M over P, right? So this is in levels, but we have taken logs, so it's M small m minus small m. So this is the real amount of money. How much you can purchase with the given amount of money. Okay? What determines how much you and me, how much money you and me want to have in our pockets? Again, the answer is not that we want to have a maximum amount of money in our pockets. We certainly don't. What determines how much money you want to have in your pocket?
So the interest rate.
Why the interest rate?
Because if we will have a high interest rate, we will consume some.
No, there's another. I mean, the interest rate is right, but there's another argument here.
The argument is opportunity cost.
Opportunity cost. What does that mean?
We could buy, with our money, we could buy bonds, for example, and with a higher interest rate, we get more return. And therefore, if we hold more money, we have opportunity cost.
Exactly. That's right. So again, money, the money that you have in your pockets, does not earn you interest rate. I mean, you could now talk about these days. You earn a small interest rate even on your bank account. So you have money no longer like physically in your pockets, but you have it on your bank account, you earn an interest rate. But this is like negligible, right? So I think it's safe to say that money doesn't earn interest. So if interest rates go up, there are opportunity costs of holding money. Because you would be better off by not having money in your pocket. Instead, you take the money and buy bonds, because then you will earn the interest rate. So the higher the interest rate on bonds is, the less money you want to have. So this is the final argument here. Interest rates at home should have a negative effect on how much money you want to have in your pocket, and the coefficient in front of it is called lambda. This is the Greek, small Greek lambda. So, opportunity cost. Right? Higher interest rate makes it more attractive to have bonds rather than money. So, this is a typical case of opportunity costs. What else determines how much money you want to have in your pockets? Well, it's probably how many transactions you want to do with that money. If you go shopping a lot, you need lots of money in your pocket. If you don't like shopping, you probably don't need so much money. So a good approximation of how much transactions you do is your income. If your income is high, you do lots of transactions, you want to have more money. If your income is low, you do fewer transactions, you need less money. Okay? And we call the coefficient here phi. So importantly, here, opportunity cost with a minus sign, so this is transactions with a plus sign, right? So more transactions means you want to hold more money. Higher interest rate means you want to hold less money.
Then why aren't we calling transactions consumption?
Well, yeah, you can call it consumption, but I mean, technically, because here we don't have government spending, we don't have investment, income and consumption are not super far away things. But I have seen money demand equations in which you write consumption. Here, for simplicity, we just say income. Because I mean, you could say you need like also money if you do transactions not for consumption purposes but also for investment purposes. Then consumption would be a bit too narrow. But I mean, I agree you could use consumption. Okay, again, money supply, money demand. Money market equilibrium is where supply equals demand. All right? And what this model is all about is the money market equilibrium, where the supply of money equals the demand for money. But from now on, we should not forget, because these coefficients play a big role, these coefficients, phi and lambda. So phi is the income elasticity of money demand. Right? Each side is in logs, so we can interpret the coefficient as elasticities. So it's the income elasticity of money demand, while lambda is the interest rate elasticity of money. At least we can call it this way. And this interest rate elasticity of money demand is negative. That's something we should all take note of this. Okay. What to do with that? Well, let's combine the three things, UIP, PPP, and money demand, all three together. Essentially, all you need to do is this. You write down UIP. You write down UIP. You replace everything. You replace the home interest rate by money demand. And then in the money demand equation, we have the home price level. You replace that by PPP. And that gives you this. So this is for you. I mean, the kickoff tonight is at 10:30, I think. You're wearing the right shirt already. But until then, you have plenty of time to go. No one from Paraguay here, I guess. No one from Paraguay here? No. So until then, you have time to do these things. So what you should do is, you take UIP, right? Then you put in money demand, and then you put in PPP. You put in PPP, and then you have equation 6. Right? It's all three things combined. So you have here now things such as the exchange rate. You have M. You have the foreign prices. You have home prices, foreign interest rate, expected future spot rate. Now, as you see, this is, I mean, not surprisingly, because ultimately, where is that, like the form of this equation coming from? It's UIP, right, in the end. So we have the exchange rate today here and the exchange rate tomorrow here. So it's another difference equation. How much time do I have? It's another difference equation. Which means you can do this repeated substitution, which we now do so well and so often. Here. I shift this entire thing one period into the future. Instead of ET, I write expected ET plus 1. I shift everything by one period. And then I can put this all the way back into the original version. It's this type of repeated substitution that we have done with UIP already, which is what we have done with the intercambial budget constraints, for example. And if you do it infinitely often, and this is my final word for today, you come to this thing. The exchange rate is the present discounted value of expected future macroeconomic variables. It's the first time that we see that expectations about the future, not about future interest rates, but about future macro variables, so future M's, future prices, future incomes, future interest rates, have an effect on today's exchange rate. Okay? So it's in this case there is discounting. Remember, I started into this session today by saying, well, if you do this for UIP alone, there is no discounting. But here, because of the interest rate elasticity of demand, the lambda here, there is discounting. So macroeconomic fundamentals far away have a smaller effect on exchange rate compared to macroeconomic fundamentals like tomorrow or the day after tomorrow. So the bottom line, and from there we continue tomorrow, is the exchange rate is the present discounted value of macroeconomic fundamentals in the future. All right. So that's it for today. Enjoy the rest of the day, enjoy the football match, and we meet again
See
tomorrow.
you, man.